So today I'm going to be talking about 5 key lessons I've learned from hundreds of millions in closed deals. So we did a little bit of a survey earlier, and the vast majority of you in the room are founders, or you're thinking of founding your own business. And there's one thing that's true for everybody in the room, regardless of where you are in your business, is that one day you're going to leave your business. And it's my hope for every single one of you, that's in the form of a successful exit, so a sale. For a lot of people, they might leave their business through retirement, they might shut their business down. And we've spent many, many years working with people to make sure when they do come to the stage where they want to exit their business or have to exit their business, they can do that through a successful sale. So just a little bit of background on me. Obviously you've seen me quite a lot today already, so you probably already have a pretty good background. But I founded FE International in 2010. We currently have nearly 40 people across 3 international offices. So we have a team here in London. You probably met many of them here today. We have a head office in Boston, and we also have an office in Singapore. In the last 8 years, we've closed nearly 600 deals. In terms of transaction value, that's in the hundreds of millions. We specialize in the sale of SaaS, e-commerce, and content-based online businesses. So one of the cornerstones of our service and what we've built over the years is a very high success rate. So if we take a client on and we work with you on a contingency basis, so we only get paid if the business sells. We sell 94.1% of the businesses we take on. For perspective, a regular M&A firm has a success rate in the region of 20%. And the reason we beat that by such a significant margin and have such a high success rate is we really focus on what buyers want and what buyers are looking for. So we have a database of tens of thousands of active buyers looking to buy companies, big companies, small companies, SaaS companies, e-commerce companies. We have a real range of buyers and investors in our network. And we spend a lot of time listening to them. So we spend a lot of time at events, we spend a lot of time on the phone, we publish a lot of content, we go on podcasts. You name it, we've probably been there or tried it as a channel to communicate with people. And we spend a lot of time not just communicating, but actually listening to what people want and what they're interested in. And over the course of the nearly 600 deals, we've learned a lot about what buyers are specifically looking for. So when we work with people and when we're talking to people, we can really help you put your business in the best possible position to eventually sell based on what we've seen from other successful sales. So, like I mentioned, 5 key lessons. So the first lesson is develop a clear mission, vision, and values. So every single person in this room, if you are running your own business, you might work in a business at the moment and have the idea of running your own business one day. You might be thinking of launching a business. It's really important to understand where you're trying to get to and what you value the most. For some people, it might be you want to run a small, profitable business and be in a really specific space. You want to make some money. You don't really want to hire people, and that's fine. Other people, you might want to build the next billion-dollar business, and that's great as well. But it's really important to be very clear and understand yourself where you want to get to. You shouldn't come to an event like this and hear a speaker and say, this is exactly what I want to do. You shouldn't let other people dictate what you want, because it's ultimately a very personal thing, what you do in your business. But the most successful business owners we work with know exactly what it is they're trying to do and what they're trying to achieve. That might change with time. So when I started out 8 years ago, I definitely didn't think I'd be somewhere like this today. I thought I would forever kind of work by myself and not build a team. So things definitely can change, and that can iterate. But it's important to be clear with what you're trying to achieve, because that will definitely dictate decisions along the way. So how aggressively you hire, how much you want to grow every year, what your targets look like, how many hours you want to work a week. Laura spoke about having a remote team. Do you want a remote team? Do you want a team in an office? There's lots of different things that come into it. And like, why is this important? So when it's just yourself, I'd say it's less important. As you start hiring people, it's really important that everyone's on the same page. If you have 10 people or 20 people or 200 people, it's really important they all have an understanding of where you're trying to go, where you're trying to get to. Whether that's numerical targets, so we want to grow MRR by $10,000 a month or 5% a month or whatever that might be. It doesn't really matter what that target is. The key thing is making sure that you actually do have a target and people understand what that target is and also why it's there. It's very important to know where you want to go. And again, that really ties into so many different things in your business. If you know what you're trying to achieve, it might be you want to be the biggest business in your niche or your industry. It might be that you don't want to be the biggest business and you just want to have a very specific company or product or service or whatever it might be that solves a specific issue for a specific group of people, and it's going to be very profitable, but it's never going to become a $1 billion business. And again, because like I said previously, I can't decide that for you, neither can other speakers or anyone else you speak to. You have to really figure that out for yourself, very much a personal thing. And when it comes to selling specifically, if you don't know where your business has been going or where it could potentially go, then how's a buyer going to know? And that also applies to your team. If you don't know, your team aren't going to know. It's going to cause people to be unmotivated. They're not going to be driven towards the same goal that you're trying to achieve. And exactly the same with a buyer. No one wants to buy a business where you don't have a clue what's going on in the business, or you think you've absolutely maxed out where the business can be in your specific space. So lesson 2, and I think this is, so I do a lot of speaking, go to a lot of events. I speak to lots of different business owners, and I think this is particularly common in the SaaS space, but I've noticed a lot of people with SaaS businesses specifically are very risk averse. They don't like making changes. They don't like taking risks. So I would encourage all of you in your business, regardless of what stage you're at, to take incremental and measurable risks. So what does that mean? Is that, like, should you just kind of change your pricing, ungrandfather everyone without any notice? It's definitely not what you should do. But if you start out by documenting everything in a business, so that could be documenting systems and processes. That could be just things like tracking your metrics. You might be using ProfitWell, Bear Metrics. There's lots of different tools out there. Depending on your business, there's not a one-size-fits-all solution. But for most of you, you've probably already got a pretty reliable tool set that you're using day to day. But the more you have documented and the more data you have to start with, when you do start making changes in your business or taking risks, you can really like measure how that's worked. There's no point doing something or trying something new if you can't measure the results of that. Some things are going to be difficult to measure and others are going to be slightly easier. But if you haven't got it tracked or documented in the first place, then it's just not going to be possible. And then from there, I would say if you're going to start taking small risks, you just have to test. It doesn't matter, just because you don't think it's going to work, or a specific customer didn't think it's going to work, or a specific customer said it would work, or you think it's going to work, that doesn't necessarily mean it's true. I'd say that a lot of things that have happened in my business over the years, they're not necessarily my ideas. They might have come from the team. They might have come from like talks I've seen at conferences or lots of different things. And one lesson I've definitely learned is you will never know what will work until you've actually tried it. You may think it will, but it may not. Some of the best things we've done are things that if we sat down at a management level, we would have not known were going to make us more successful. And then I think it's also, particularly in a small business, all of you have the opportunity to innovate. So a lot of big companies out there, they kind of move very slowly. They have long approval processes. There's red tape. It might have to go through 5 layers of management before you can get approval to change the color of a button on a homepage. But one of the good things about being a small business, and one of the ways you can take risks that the bigger companies can't necessarily do, is being able to innovate. And that you don't necessarily need to be reinventing the wheel every single week, but you can test new things, you can try things that your competitors haven't tried, or do things your competitors have tried and kind of make it incrementally better, and then measure the result. And the best businesses we see have done that consistently. So as your business grows, test new things, make small risks, measure it, and that will help your business grow over time. So the third lesson, and this is something that sort of opposite of the previous slide, this is something that I think SaaS businesses and SaaS business owners do very well, and that's building a sustainable business. And what does that mean, like in the day-to-day of a business? Like obviously everyone wants to build a sustainable business, and they want something that's going to be around for a long time. But in any business, it's really important when you're making decisions. There are going to be some decisions that are going to benefit your business in the short term, and there are some that are going to benefit the business in the long run. And then there are some decisions that will do both. So I would encourage everybody, regardless of what stage you are in your business, to make decisions that are relevant long term. So don't just do the thing that will put the quickest dollar or pound or euro or whatever in your pocket. Do things that will put 100 euros, dollars, pounds in your pocket in 5 years' time. And if you start shifting your mindset away from how do I make a dollar tomorrow to how do I make many more dollars in the future, over time your business will continue to grow, and hopefully in a very sustainable way. Another thing you can do within your business, and again, this will really depend on your size. As you hire more people, you can do this. And as you learn more about your industry and your customers, you can do this. Start removing single points of failure. So during the panel with Laura, she was talking about, she has a great personal brand, but a lot of people are now signing up to Edgar, her product, without knowing who she is, ever having met her or seen her content. I think most founders, when they're starting out, a lot of their business comes from them personally. So they might be on stage, like this. They might be the ones physically writing the content. They might be in the video. They might be the one on the podcast. Whatever that might be, you've all got different channels of customer acquisition. But as your business grows and you build a team, you can get to the stage where you remove those single points of failure. And in most small businesses, the biggest single point of failure is the founder, or founders if you have like co-founders, whether that's 2 of you, 3 of you. I've seen 4 people starting businesses. So as you grow, look to remove single points of failure. In a SaaS business, that could be things like a specific source of customers. So that might be you're running, all of your customers come from Facebook ads. All of your customers come from organic traffic. All of your customers come from conferences. It doesn't matter what that is, but as you grow, start to diversify and remove those single points of failure. Another thing, and I think this is very difficult for particularly those who are really entrepreneurial minded, it's really easy to kind of jump between ideas, whether that's business ideas or marketing ideas, sales ideas, product ideas. Most of you will be 100 ideas a day. And then particularly if you come to an event like this, it's really easy to kind of leave with pages and pages and pages of notes. And that's great, but it can also be a distraction. So say in any business, one thing I've learned, and you don't necessarily need to do this yourself, this is where hiring is a very powerful tool to grow your business. If you find things that work, what a lot of entrepreneurs do, if they're just by themselves, they'll stop doing it and they'll move on to something else. So they'll write a blog post, it will do really well, bring in some customers, and then they say, oh, that's great, I'm going to go test something on Reddit the next day. And then they might go try some Facebook ads. And they don't do that thing consistently. So if you find something that works in your business, find a way to repeat that. So it might be with the kind of documentation and processes I was talking about before. It might be kind of hiring someone whose job it is to do that consistently. But it's a really good way to grow your business and compound that growth over time by just doing it's usually not the fun stuff, but the things that do work, do them over and over again, do them consistently. And a lot of these things compound. So content marketing, for example, is a great example of that. If you're not publishing content regularly and you're not consistently kind of doing outreach to get links, you're not consistently emailing your customers to read your content, then you're probably not going to grow. But if you publish a piece of content every week or every month, it might be 1,000 words, it might be 5,000 words. Sometimes we write 20,000 words. It doesn't really matter, and it will really depend on your clientele. We work with some very technical people who want lots of content, and other people might want 800 words might work better. But the key is consistency. Do it time and time again, publish consistently, and it'll mean that your customers will kind of get a better understanding of what to expect from you over time. So lesson 4, and this is very specific to SaaS businesses, is in your business, if there's one metric you focus on, and this is assuming you have some traction and your MRR is growing in the right direction, focus on churn, and very specifically focus on revenue churn. So in any SaaS business, you have customer churn, you have revenue churn. A lot of people fixate too much on customer churn. So I would encourage all of you, assuming you have a value-based pricing plan that Patrick was talking about first thing this morning, look at revenue churn, completely ignore customer churn, and that's going to put you in a good spot. And I'll go into a little bit more why later. And also listen to your customers. And when it comes to which customers you should listen to, what you tend to find so we look at tons and tons of SaaS businesses, what almost every business has in common is the customers that pay you the least amount every month will send in the most support tickets, the most complaints, they have the most questions, the most feature requests, they demand the most of your time. And then as businesses get bigger and pay you more and the company you're dealing with gets bigger, those questions become less. They might not send you any questions. They might pay you month after month very happily. But what a lot of people do, a lot of business owners, particularly when it's just you or you're building out your team, they spend all of your time focused on the customers who are shouting the loudest. They don't actually do any analysis on who those customers are. And what you'll often find when you do the analysis, so do some cohort analysis, if you have 3 pricing plans, so you have say a $19 a month plan, a $49 a month plan, and say a $199 a month plan, what you'll find if you look at the data in almost every SaaS business is the $19 a month cohort will be the ones that send in the most support requests per customer. So if you shift the mindset away from pleasing everyone to pleasing the customers who have the ability to pay you more with time, then that's going to help your business grow longer term. And that's why revenue churn is the important metric, not customer churn, because you should be worried and concerned about the biggest customers and what they want and not losing them, rather than worrying about the highest volume, which will, again, in almost every SaaS business, be the cheapest price plan cohort. And again, I mean, the underlying kind of mindset is build for your biggest customers. That doesn't mean as soon as your biggest customer has a request about a feature or they want something specific, that doesn't mean you should necessarily do it. But as you're planning your roadmap, just keep that in the back of your mind. Like, what do your big customers want? What's going to help them pay you more money with time? So we, again, going back to Laura on the panel, she very specifically does not do that. She's built one product at one price point for one specific customer, and that works really well. But she knows exactly who she's targeting. So that's also really important, is focus on your biggest customer or customers, and also focus on those who are the ideal target market for you and your product. And again, even if you're in exactly the same, you might have 10 competitors who do very similar things, you're probably all going to have a slightly different target market. So it's important you understand who that is and who your best customer is. And that's usually, I would argue, the customers who pay you the most. So lesson 5, and this is very specific to thinking about selling a business. the catalyst for a conversation with us is often, I've been running my business for a number of years. It's been doing really well. But in recent years or recent months, it started to decline because I haven't had time to work on it, or I've been working on another business or another product. One thing I've learned, and is common for almost all of the successful sales we see at premium multiples, is businesses that sell while they're still growing command significantly higher valuations, better deal terms than businesses that are not growing. And it seems kind of counterintuitive. Most people say, well, my business is growing, why would I want to sell it? But it's always something you should consider, particularly if the growth is something you can control to some extent. Like I said, a lot of people will sell when they've stopped working on a business. They don't have that much time anymore. So you can almost predict the fact it's going to start to decline. So that's a good time to have that conversation and start thinking about selling. And the next point is exiting before you become stagnant. And stagnation really applies to lots of different things in your business. It might just be personally. So a lot of people we work with might have 2 products, and both of them are profitable. They're both really great businesses, but one is growing significantly faster than the other. So one might be at, say, 1 million MRR, and the other might be 100K MRR. So in that situation, they might look to sell the 100K MRR business, and that's not because it's a bad business. It's just that the business is going to eventually become stagnant. Their own interest is waning because they're using time elsewhere, and that's a perfect time to start thinking about getting out. And another thing is, this is where, again, going right back to the first lesson, which is kind of knowing where you're trying to get to, having a very good understanding of your own ability and your own skills in your business is super important. And that's, have you taken the business as far as you can yourself? If you look at most bigger businesses, as they grow, often the CEOs might only be in the company for one or 2 years. And that's not necessarily because every CEO out there is bad. It's usually that CEOs or executives only have the ability to take the business to a certain next level. So you have to be very self-aware in your own business. Are you the right person? Do you have the right skills, the right resources to keep your business growing? And if the answer to that question is no, then I would encourage you to start thinking about what an exit process might look like. And the final point is taking emotions out of the equation. So running your own business is, like, yes, it's business, but it's also a very personal thing. And we have Sherry speaking tomorrow about that in a lot more detail and kind of the emotional side of things and the kind of psychology behind that. But regardless of how personally you take your business and how emotionally invested you are, you've started it from nothing, you've worked 80 hours a week for however many years, all of your personal net worth is tied up in that company. I completely understand the emotional side of things, but when it comes to making a business decision, it's really important to be objective. So if you're not self-aware enough to understand when you've got your business to as far as you can take it, then it's worth speaking to some other people, maybe speak to some peers and figuring out, are you making the right decision for your business objectively, or are you just making kind of the emotional decision, which is usually the decision most people make first. Or their immediate reaction is emotional, and then if you take a step back, you can often make it a little bit more objective. I think that's really important as well. So before we go into Q&A, the most common question I get from, again, we go to lots of events, speak to thousands of business owners every single year. So the most common question we get is, so what's my business worth? So to preempt 100 of those discussions, I'm just going to talk a little bit about how valuation works. So at FE International, one of the things we've built over the years, and this is really a culmination of tens of thousands of data points, is a proprietary valuation model. And what our valuation model does, effectively at a very simple level, is it pulls in data from successful sales and deals we've completed. And then when we're valuing our business, we can accurately look at and effectively model out what that business is likely to sell for based on other sales we've completed. So in our business, data is really important. We track everything. We track thousands and thousands of metrics. We figure out what works well, what doesn't work well. And if something doesn't work, that's not necessarily a problem. You can use that data. And if something does work, you can also use that data as well. So when it comes to small businesses, and the caveat here is if your business is below about 5 million in revenue or $1 million a year in profit, it can kind of go either side of that as well. But as a guideline, your business is going to sell for a multiple of your seller discretionary earnings. So what that is as a calculation is effectively your revenue taking out any costs, which effectively gets you to your net profit. But in most small businesses, what people do for generally tax reasons is they'll run their business as close to zero profit as possible. So seller discretionary earnings takes out anything that a founder pays themselves, takes out any discretionary benefit. So that might be, in the US, that's healthcare is really common. It might be a company car. It might be a pension. You might hire family members. Tons of different things business owners can do to get their profit on paper as close to zero as possible. So we adjust out all of that, and then we would also adjust out any one-time expenses. So if you've spent £100,000 or dollars developing a new version of your product, then we can also adjust that out. So SDE, or seller discretionary earnings, is really looking at what the business would make if you weren't making one-time investments and if you were not paying yourself or taking anything out of the business. And that really levels the playing field, because what you find is some small business owners, if they're optimizing for growth and they have another business paying them elsewhere, they might take no money out of the business personally. And then someone else with 5 kids who lives in London might have to pay themselves $200,000 a year to be in exactly the same position. So by using seller discretionary earnings, it levels it. So it's kind of standardized across all businesses and not reliant on the founder's personal situation. And like I mentioned, we deal with primarily 3 main business models. For most of you in this room, you have SaaS businesses. I put the other models up just as a comparison. So SaaS businesses in general sell for somewhere between 3 and 6 times the annual seller discretionary earnings. And then content, e-commerce-based businesses, somewhere in the 2 to 4 times range. And again, that's not an exact number. I can't give you a valuation on the spot, unfortunately. There's a lot more that goes into it than that. But it gives you an indication of where you might be, which ties in to some of my key takeaways. And the bottom takeaway here, but the one that's relevant to valuation, is understanding what your business is worth. There's no point me saying to you, hey, sell your business while it's still growing, sell while it's stagnant, make really personal decisions, if you don't know what your business is worth. So by having an understanding of what your business might be worth today, it can put you in a good position to make that right objective decision about where you want to get to. And a lot of people we work with, they might speak to us many, many years before they decide to sell. And the vast majority of you in this room have probably never thought about selling before, and you have no intention of selling. And that's absolutely fine. For most of you, if your business is healthy and strong and growing, you probably aren't thinking about selling. And that's great. But having an understanding and an awareness of what your business is potentially worth if you did need to sell might help you make some other decisions. So it may well be that at the moment your business is worth 5 million and you want to grow it to 6 million. The decisions you might make there could be completely different from that, from another business owner who's at 5 million and wants to get to 50 million. So having that understanding is important, even if selling is not on the radar for you at all. So going through the key takeaways super quickly. So know where you're going. So you might not know that on day one, you're probably not going to have a clue where you're going, and that's fine. But as your business grows, as you get some initial traction, have an understanding of where you're trying to get to with goals, targets, personally, professionally, in the business. Document and iterate your processes. There's no point taking risks and iterating and trying things unless you have actually documented it and tracked it in the first place. Focus on revenue churn. So I would encourage you to almost entirely ignore customer churn and just focus on revenue churn. The only slight consideration there is your smallest customers could be the loudest, but that could also mean they're quite active on social media or other channels, which might mean that you do have to balance the kind of PR effects of just focusing on the bigger customers. Listen to all of your customers, but I purposely put big in square brackets there because they're the customers I would encourage you to listen to the most. Sell while your business is still growing. And again, that's very counterintuitive. If your business is doing well and it's growing, that's a great thing. And hopefully you've not come in here thinking, hey, I need to sell it tomorrow. And that's perfectly fine. That's perfectly natural. But the best time to sell from a valuation perspective, so on the previous slide, I showed the range of valuations, which is, say, 3 to 6 times. One of the probably the biggest variables in our valuation model is how much your business is growing. So growing business is probably going to be at the higher end of the spectrum and the range, and a business that's not growing or even declining is going to be at the lower end, or maybe even lower than that. So if you want to learn more, obviously I'm here for the rest of the event. Also, some of our team are here, so if you have any questions, feel free to grab us. If you want to talk privately, then feel free to send us a message. I'm happy to do that. And hopefully we've got a little bit of time for some Q&A. So thank you very much.
All right, we've got one question on the Twitter. Have you noticed any peaks and troughs in the SaaS market, or general trends?
So I'd say I use the term sustainably. It's been multiples have been consistently increasing for a number of years. We've always put it down to lots of different factors that go into it, but a combination of macroeconomic trends, like the economy worldwide at the moment is good. There's lots of buyers out there with a lot of cash actively looking to buy, invest in businesses. As we've grown as a firm in general as well, we've got access to more buyers. We have a bigger team. We can do more deals. And that generally means we can command higher multiples and better terms than we could have, say, 5 years ago. So I'd say, in general, it's only been increasing. We haven't seen a trough yet. I think they're predicting the future a bit, but if and when the next recession comes, that will probably change things a bit. But we don't know which direction that will go.
Yay, future recession. And one other is, how do you perceive balancing the leftover growth potential and having a growing business with, like, you don't want to sell it too late, like you were saying, but how do you, what's some good indicators of that?
It's a difficult. I mean, I think one of the important things is being aware what your business is worth, because then you can figure out how much do you need to grow. The other thing is figuring out from a skill perspective, how good are you going to be at? There are some things that may require cash or a specific skill set that most business owners don't have and might not necessarily have the resource to hire. In almost every business, if you're a true entrepreneur, you're going to have hundreds and hundreds of ideas to grow your business, and that's great. But I think you need to be kind of honest with yourself as to what's really going to move the business forward. Because in most businesses, there's 2 or 3 things you're going to do that are going to make a incremental improvement, and the rest of them are going to be negligible, ultimately.
Cool. I'll open to the floor for one more, if anyone's got anything bursting out of their chests, emotionally or intellectually.
I think we'll...
Oh, okay. Bursting.
Thanks. Hi, how do you account for, so you mentioned one-off software costs, like if you spend 100 grand on like a development project, our development team is in-house, like we employ them, so we do new deployments every Tuesday, new features and so on, but you don't need them. Like an acquirer could go, okay, like, you know, clearly you need at least one of them, somebody's got to do technical support, but you don't need the rest of the team. Would an acquirer understand that, or would they look at that and be like, no, you employ 4 developers, like, that's not SDE? How does that work?
Yeah, it's a tough one. So firstly, SDE, if you put 10 of my competitors on stage and ask them the same question, everyone's going to have a different answer as to what SDE is. There's not like an exact industry way of doing it. The general rule of thumb would be if it truly is one time, like you've just launched version 2 of your product and that required 5 developers where usually you have 1, then you're going to be able to add that back. If you have a team working on the business consistently, you're paying them every month and you're rolling out a new feature every week, then it's probably not going to be. So there's always a balance between growth and managing costs. I would say to most people, if your business is growing, you definitely shouldn't be like firing people or cutting back on team just for the sake of improving your SDE for a sale. So keep those people, keep rolling out those features if it's a good thing for your business. That's where like measuring is quite important as well. If that's actually improving your business, then keep doing it. If it's not, then you have to look at it objectively and take the emotion out of the process. But yeah, in general, if it's paying consistently, then it's probably not going to be an add back.